Welcome to the HFMA Talk podcast, the podcast for NHS finance. I'm Alex Hunt, and in today's episode, we're bringing you a recording of a recent session from our pre-accounts planning event, our annual event designed to assist all those involved in the planning and delivery of the 2025-26 annual report and accounts. In this session, chaired by Lisa Robertson, Senior Policy Manager at the HFMA, we hear from Ben Sherriff, Associate Partner at Deloitte, who discusses some of what auditors are focusing on this year, the takeaways for finance teams, and in-year development topics.
My name is Lisa Robertson. I'm a Senior Policy Manager here at the HFMA. Today, I am absolutely delighted to be joined by Ben Sherriff. He's the Associate Partner at Deloitte, and he's going to give us a technical update from an audit perspective. For those of you who have not heard Ben before, his session will be full of the most important information and reminders. So without any further delay, I'm going to hand over to you, Ben. Thanks.
So, hi, I'm Ben Sherriff, as mentioned, Associate Partner in our Public Sector Audit Team and National Technical Accounting and Audit Practice. Things I was looking to cover today was just a little bit of perspective of what's currently going on in the world of financial reporting and auditing, which includes some things which aren't directly public sector relevant, but are the things that feed into the training that we deliver to all of our staff, including our NHS audit teams, and so will be in the minds of things that your auditors will be thinking about, and some of which is things that aren't directly relevant right now, but are a little bit further down the line. And then in terms of being ready for audit, what is it that auditors are expecting to see when they come out to audit? And what are some of the current reporting areas of focus for this year? I'm going to touch on some of those in more depth than others, but very happy to expand from the comments. I know some of them have got picked up in the NHSE sessions earlier in the week from the sort of technical side, and really just looking to touch on an auditor's point of view on some of those changes for this year. So first, the current context of what's there. As regulated organisations, you are used to worrying about what NHSE and Department and indeed CQC more widely think of what you are doing as organisations, and audit firms similarly are regulated and inspected, and that drives some of our thinking of what are we focusing on, particularly if a matter's got raised. So the context of that is Financial Reporting Council that has an audit quality review team. You review the audits of NHS trusts with expenditure over 875 million, so the largest NHS trusts. That number has gone up from 500 million. It was a change in the law this year, and they also inspect ICBs. The AQR is the major regulator for audit. They're the ones who look at listed companies. They publicly report an overview of their findings each year. Historically, they've done that for NHS and local government audits as well. They didn't do that for 2025 because of the issues that have been happening in local government. They didn't inspect any. So they looked at sort of 6 NHS bodies and didn't think they should do a report just based on the back of that. So there wasn't something public last year, but there have been in previous years. And they're planning to carry on inspecting 6 bodies from among that set of large NHS trusts and ICBs. For the bodies that are smaller than that, for foundation trusts, the Institute of Chartered Accountants England and Wales has a quality assurance department who do the inspections of those, some of them as part of their legal duty, some of them for the FTs under agreement with NHS England. That doesn't come through as much as being a public reporting, but it's still viewed as a very significant thing within the audit firms, and the recommendations that come together from the FRC and ICAW on that shape what some of the audit firm concerns are. In the last sort of public report, points that had been raised by the FRC on NHS audits had included points about group accounting, about quality of consolidation and impairment tests. I think it was overlapping between NHS and local government, and point about impact of errors affecting whether things are in surplus or deficit. And so even if an error was quantitatively immaterial, less than the sort of materiality threshold, but it was changing an organisation from being in a surplus to a deficit, how was that being considered, and whether there's more sensitivity to those, and impact of errors on the remuneration report or staff report, where again in pound terms those may not be so significant, but need more consideration by the auditor in concluding if they're genuinely material to users. The FRC also undertakes reviews of annual reports of listed and large private organisations, although not NHS bodies, and they publish an annual review of the findings that they've been raising on those. And there's obviously a lot of overlap between the things that they look at when they're looking at the annual reports and the things that they look at when they're looking at audits, and passing those messages back and forward of our auditors looking at these things appropriately. The top three things on their list: impairment of assets, historically not really an issue for the NHS. With the change to how PPE and already intangibles are being not moving away from annual evaluation and needing to think whether there is a need to do an impairment review and consider impairment indicators, that will become more of a focus going forward within the NHS audits, but probably not quite for this year. Cash flow statements and the appropriate presentation of that. Generally, that has not been too much of an issue because most people's cash flow is flowing from within the tax and how those are being constructed in a sort of automatic way. But it has occasionally, there are questions that come up on NHS cash flows as well, if someone's doing something unusual. And financial instruments has been the other common big one there. You can see if you look over the years on presentation of financial statements and whether things are in the right place between debtors and creditors, geography within the balance sheet, whether notes are being appropriately presented, that has moved up from being 9th in their top 10 topics a couple of years ago to number 4. So clearly something they're looking at more, and so auditors looking at a bit more. Other things with NHS relevance, revenue and how that's being disclosed and accounted for, disclosures in the strategic report and front half narrative reporting, what's being disclosed about estimates and judgments is there. Tying into the point of FRC raising points about group auditing, also have raised a number of points last year about consolidated financial statements and how those were treated. Generally, it's a much more complicated in terms of their groups and group structure and how things are treated than the NHS. But there are a few things around where people have done slightly more complicated things with joint ventures or partnerships and some things we're aware that people have been exploring doing, and just thinking about how does this ultimately flow into the accounts and get presented in the accounts if you're doing something different, and how are you making sure that the mechanics of consolidation are correct. I think an observation we've had is that because historically NHS bodies have had very simple groups or not groups at all, sometimes when something more complicated starts to happen involving a subsidiary or a joint venture or partnership, that the finance system isn't always set up to capture all of that appropriately. And the other item there with a read across is TCFD, where this is the first full year of reporting for the public sector where all of the elements of the TCFD disclosures are required, something that auditors will certainly be looking at. It's not an audited disclosure, but we are required to read those and check that you've been including the appropriate disclosures in the front half, and we will be having comments when we're looking at those and thinking about the points that have been raised in some of the FRC's reviews around those. If you want to know what the good looks like, effectively, the FRC does thematic, as well as doing inspections of individual sets of accounts annual reports. They also do thematic reviews, which usually have examples in them of good practice of disclosures in different areas. And what they've liked when they've been looking at examples of annual reports that have explained things well. Many of those are on corporate areas, but there's been a run of them about climate change disclosures and sustainability disclosures, that if someone in the organisation is pulling together the TCFD and wants to look at some examples of good practice, there's the FLC's examples there. There's also a guide that Treasury put together of examples from public sector disclosures that could look at as well. But there are also publications on things like judgments and estimates and what a good disclosure in those areas looks like. And these things are what the audit firms are taking as being where good is at, and the kind of things that get pointed at in our training of what you should be challenging organisations to do. One of these that they'd done was what makes a good annual report and accounts, which was like from a corporate angle. The National Audit Office has also put together a guide to this and on their view of good practice in annual reporting, but with a public sector lens to it, which is available. It's all just on the NAO's website. The themes that they're expecting in the annual report and accounts, that it's telling the story in a way that supports accountability, is accessible and clear in what it's saying, that's transparent with a frank and honest analysis, including on challenges the organisation is facing, and that to the extent possible, it's understandable using plain English in how to communicate things. I think some of those come together with areas we look at in the audit. So I'll pick up a bit later about value for money, but many of the things that are value for money issues or risks are things that you would expect to be being talked about in the narrative reporting in the front half, that would be in the annual governance statement, and seeing that there is an open story being told about challenges or about financial risks is something that the auditor will look at in seeing, is the annual report fair, balanced and understandable, and where those things are issues about accounting estimates or judgments that are affecting the financial statements, that there's appropriate and clear disclosure explaining what the judgment is that's been taken and the basis for it is something that we'd look at in there as well. In terms of being ready for audit and how that flows through, I think just to start from what is it that the auditor is looking for when we're making requests, and what is it that we mean if we're raising a challenge about whether we're getting appropriate evidence or support for something. I borrowed this again from a publicly available document from the National Audit Office. Different firms will have different ways that we communicate this with our audited bodies, but this is a nice publicly available summary of things to think about, of sufficiency of evidence. If there's a number in the accounts, is there enough evidence to support the position that has been record there, either something that agrees to that number or that is the support for the basis of making an estimate or for a judgment that's there. Are we being given evidence that is relevant to the thing that is being supported? And sometimes when you're asking for support, the things you get back don't quite marry up with what's there. And the reliability of evidence. So third-party evidence is better than internally generated evidence from within an organisation. If that's available, that is what we're looking for. If you're looking at something like an accrual or provision where you're making a judgment, some clarity of how that has been, what the approach has been that's been taken, and what evidence was there for the basis of making that, even if it's not something that you could agree directly to an external source, but if you've looked at some track record of past experience, or you've based it on an average of some other items by comparison, this is what the backing is and lines up. And I think just a useful thing sometimes when explaining inside finance teams to people who haven't who've only experienced an audit from the side of being asked questions rather than having experienced audit from having had a training within the firm and know what the auditor's trying to do. Sometimes this what are we actually after in terms of evidence can be useful to discuss that. And I know a lot of finance teams do that sort of internal briefing, and a lot of audit teams are very happy to do attend those. But this is where we're coming from, making that in some more concrete points on expectations on what makes a good work paper. HFMA has put out a good guide on the kinds of things looking at. So everything within the accounts supported by an appropriate working paper, clear audit trail from the accounts to the ledger with appropriate reconciliations. And in that, I think thinking about what the interaction is between the financial statements and the tax and the ledger. Probably most organisations now go from ledger to the consolidation schedules that you need to send to NHSE to the accounts rather than preparing accounts and then preparing consolidation schedules. And the tools that have been provided to help link the two together are great in terms of efficiency, but just what's that logic of that flow? And if there are disclosures that you're needing to include in the accounts that are not coming directly from what's in the TAC, how, for example, for trust-only numbers, if you've got a group, how is that flowing and what is the mapping that's making that happen and what's the explanation of that trail? Ideally, working papers would be following a nice clear format, and so we can see who's prepared them, that there's been review of those, that there's an explanation of what are significant matters or assumptions that are in there. People differ, but I've always preferred to have the discussion up front about what actually the issue is or what the judgment is and what are the things that have concerned you or which are more complicated in preparing a balance before we start auditing it, because ultimately those questions and discussions are going to come up at some point when we've picked a sample and done testing. It's better to understand those and build that into what you're doing as a test than to find them out later in there. As for external evidence, where possible, explanations on what's going on in what's actually the year-end balance rather than a build-up of reversing journals or contras, evidence on reconciling items, and with some sort of analytic sense check of if this number is very different to prior year, very different to budget, what actually is that? Because again, those are the kind of discussions that we'd be raising. That's some general points on working papers. So a touch around on value for money, because this overlaps to several bits in the finance team as well as more widely in the organisation. What is it the auditor's required to do? So the requirements set out in the standards for us are to understand what the organisation's arrangements are around financial sustainability, governance, improving economy, efficiency and effectiveness. We then have to assess if there's a risk of significant weakness in arrangements from that understanding. And if there aren't, at that point you sort of stop. But if you identify a risk of significant weakness, you then have to design and perform procedures to conclude on that. And if we identify a significant weakness, make a recommendation in writing. And regardless, we will be issuing a narrative commentary in the auditor's annual report. Now, common areas of issues that come up: financial sustainability in terms of performance against target, but also sometimes just management of cash. Those are issues that come through. There were quite a few quality and CQC related VFM issues, but also wider governance matters can come up if there are issues in that. Last year, there were 77 providers with a modified VFM conclusion, up from 67 for FY24. And out of 215 providers, I think it is, that's a significant proportion, so it does come up quite often. We do expect a link between the kinds of things we're considering here and what is it that's in the organisation's disclosures. So the annual governance statement's meant to be giving a balanced reflection of the entity's position and control environment. That should be consistent with internal and external findings, and clearly if there are significant weaknesses or issues that are even below that level that are coming through, then would be expecting that to be showing up there. If there's a financial sustainability issue or an issue about risk or about performance, then would be expecting that to be showing up also elsewhere in the narrative reporting. Some of the governance significant weaknesses do come up where there are issues around the financial reporting process, delays or problems in that and in the capacity and within the finance team, and where there have been problems in what is going on reporting and close, upfront and transparent with the auditor if there's an issue happening, more times needed to deliver quality working papers and a good quality close and a reliable set of accounts. It's better to have that conversation up front and maybe take slightly more time to get that close done right, rather than rushing and issuing something that perhaps is incomplete or has a lot of issues in it in order to, in theory, meet the timetable in April for initial delivery. But actually, those quality issues mean wasted time at the start of the audit and actually risk hitting the timetable and put at risk cases by some way missing that timetable. And just that has been through into some of the BFM type commentary for organisations. In terms of financial sustainability, there's a big link between what we are thinking about in this and some of the things about talking about financial risk, talking about performance, talking about forward-looking things in the annual report. And it is always difficult because there's a mix between is the organisation doing the appropriate things internally and having appropriate processes and arrangements versus what is going on in the wider local health economy and wider funding arrangements that may not be behind some of those issues. But the starting thing is whether an organisation's actively managing and understanding pressures with appropriate transparency internally, and whether it's setting realistic plans and savings targets, and the timeliness of doing that versus year-end is the plan being set with those savings largely developed or with significant gaps against what the required saving target is. And if there are challenges coming to the draft plan saying that sometimes the number that has come out is not acceptable centrally and organisations are asked to revise their plans, is that going through appropriate consideration and diligence? As sometimes been seen, is the number being moved by a significant amount and saving plan added without robust consideration behind actually can that be done? And clearly the nature of gaps identified and whether those are things that are properly understood within the organisation and whether that's in the body's control or not are factors we'd consider in looking at this. So that's the BFM. Now comes the FY26 very specific bit here of hot topics for this year. I'm just going to touch on these and some auditor thoughts on each of them. ICB mergers and restructuring, and indeed restructuring and reorganisations and mergers in trusts as well. Lessons from when this has happened elsewhere and before. It's important to have robust documentation around redundancies, about who has ownership of processes and controls and what's happening there, what's happening with transfer of knowledge in organisations. Those are operationally a big deal, but also in terms of the ability to audit them afterwards. Ultimately, when the auditor turns up and is looking at the numbers and set of accounts for the year, those figures being presented for audit are being presented by the people who are in post at the end of the year and are being signed off by the accountable officer who is in post at the time of signing of the accounts. And they need to have the understanding to take responsibility for those and to be able to answer questions through the year of what has happened with the transaction. And so having a clear process around and saying what's happening on staff changes and who's responsible for doing what there is important. Cash and cash flow statements, I mentioned it was an FRC area of interest. And so if there is something unusual in terms of whether something is actually a cash item, cash movement, that is something also we'll focus on. There haven't been too many audit issues in the NHS around what is the number for cash itself, but the availability of cash, and if you're an organisation which has reached the point of being cash constrained and not having access to additional cash support from the centre, then that increases the importance of cash forecasting and management arrangements for the organisation, and that's something that might then feed into VFM considerations. So because your accounts seem to be going in other sectors, we would worry about going concern. The requirements are you will still prepare your accounts on a going concern basis, but you would be making appropriate disclosure about financial risks and challenges the organisation faces. And from the VFM point of view, whether you've got that forecasting management arrangements there, something to understand. IFRS 17, insurance contracts. Our understanding is that I think one NHS body in a very specific circumstance has identified something so far NHSE was aware of, which it does suggest there's not much there. I think I'm pretty readily persuaded that there's not much there for most NHS organisations, but we need to know that the organisation has been through a process to consider whether anything applies, whether they have contracts affected, and if you can clearly set out you've been through some process of thinking about this, I expect your auditor will be reasonably comfortable with that. But do you need to have had that thought process and writing something down that explains your thinking? I think will be and just the auditor can consider it, ask any questions they need, put that in a file, draw a conclusion that that lets the issue get closed off. If it's you saying that you haven't found anything, but there's not something to consider, then it can become a question that just sort of carries nagging on through the audit. The better to just do something that puts it to bed, send a paper to the audit committee saying your assessment, and close it out, I would suggest. Clearly has been a number of challenges around that and impact there on some of processes from the mid-year ledger change for ICBs. There is some national work happening about that transition. Exact form I think still has to be finalised, but I think it's important to note that the service auditor reports that you get and that national assurance they're written for the benefit of the organisation, and the reason for it being there is to form part of in first order, part of the assurance of the organisation that the total control environment that they've operated in the year has been appropriate, and that part of that is the ledger transition, and that things have gone to the right place, and that controls have continued to be implemented appropriately, and that processes have worked properly. That it's not a report for the auditor; it's a report for you to be able to be happy why you are comfortable with the ledger transition, and being able to explain why you are happy about that to your auditor is then the step that comes after it. So if there are any weaknesses or gaps in assurance that have come up, clearly that's something to owners and organisations say in your annual governance statement, potentially discuss with your auditor in terms of flow to what they then need to think about in their audit. On the accounting side, there's been the change to valuation of intangible assets of no longer being revalued and needing to instead think, are there any impairment indicators? Is there an impairment here? Depends on the materiality of your intangible assets, how significant that is, but in use and in operation, that probably is a relatively easy question to answer of, are there any indicators of impairment? But that is a consideration for the organisation to make. You are required in accounting for things by IAS 36 on impairment to consider if there are indicators of impairment, and if there are, to do an impairment review. And your assessment that there are not indicators of impairment is the thing to set out and explain to the auditor, and then for the auditor to challenge. If you have thought about it, that is an easier conversation than the auditor raising questions and challenges afterwards. And that will flow for next year with the changes coming to PPE valuations as well on this. For this year, as sort of final year in this process, we're aware some organisations are looking again at their MEA and alternative site assumptions before going into New World, and could be some challenge to changes being made to assumptions, and are those appropriate and reasonable. For TCFD, clearly the final phase 3 of strategy element of TCFD is coming in this year. We do recognise the importance of sort of proportionality and consideration of materiality in what's being disclosed and how much needs to be said there, and whether what's being said about TCFD and the extent of discussions is consistent with what you're saying about other key risks. But if you have a principal risk around climate in your risks you're talking about, then clearly that would point to more to say about sustainability. And the other one, just mentioned, it's a next year issue, and it's for charities rather than for the trust audits themselves. But there is the new charity SORP that's going to be effective for 26, 27. And that has some changes and for lease counting or revenue recognition, and also the equivalent changes in those coming from changes in FRS 102 that would be affecting if you've got subsidiary companies accounting under FRS 102. And so those are worth starting thinking about. Disclosure about upcoming changes to accounting policy will need to be made in those subsidiary and charity accounts. And it is important to note that lease accounting in FRS 102 and the charity SORP is not exactly the same as lease accounting under IFRS 16. It's pretty close, but not exactly the same. And it's not the same as for trust-only accounts under the GAM. And so there may be just things to think about there, or items that were immaterial for trust but material for subsidiaries or charities to just think about on that process. So those were this year's hot topics. The three things that are regular issues for audit: income recognition, capital programs, provisions and accruals. These are regularly issues where risks are identified by audit, areas for challenge in it, and where can be issues in the quality of support that we're getting. The starting expectation on revenue would be that there are signed contracts in place and agreements with a clear trail from those contracts to your and any modifications to them, to your assessment of those against IFRS 15 of how they should be accounted for, and any areas of complexity or judgment in those. And that would then flow into what revenue you've recognised. Do you recognise there are not always signed contracts in place? There are often modifications to them. Having a clear, documented basis of what is it you have used as your basis for your understanding of what your contractual agreements are. If it is not off a signed document and is off other things confirming changes to amounts, what is the trail of that, and consideration of whether things are part of the main contract, are separate, what are your performance obligations, when do you fulfill them, treating people who come in and over time recognising, so you're treating people, they've come in, you've treated them, you recognise that revenue, that is straightforward. Where you have things around the edges of contracts that are cutting over the financial year, that is where the complexity comes in, and often where the quality of documentation is weaker. Capital programme, making sure it's thought about detail of what's in there. There's a good HFMA guide on things to think about capital accounting, and also about accounting for IT type projects, software as a service, where you've got a cloud type arrangement for the software. There are good guidance to that in the NHS context you can look at. And provisional accruals, again, on estimates and judgments, just setting out your thinking and capturing it, and what is the basis for the judgment being taken. Those are what we're expecting to see. We'll wrap up with a message that really one of the important things in good interaction with the auditor is explaining what you've done, having a clear explanation, but in the first place in what's actually in the annual report and accounts and in the financial disclosures, but then in working papers and in explaining, setting that context of what is it you've done when you're having a discussion with it, clear articulation of what are the accounting treatments, assumptions, processes. Those things can all go to simplifying the audit process and demonstrating robust management of your financial reporting.
Thank you, Ben. As always, I think you covered an awful lot of ground, and that's really helpful. And I think when time is an issue, it is actually just so helpful to have that kind of reminder in a session of some of the key things that we think about, and actually getting those things right actually does save so much time in the end, doesn't it? Do you think that the proposed changes to valuation of NHS assets will affect the usual impairments when assets are valued on first being brought into use?
Yes, I mean, there's definitely a bit of a challenge here of what's happening when an asset is first being brought into use, and what is the valuation basis logic. I think there's a little bit of thinking happening to give some guidance to this going forward of how to think about it. Because one answer is to say, well, your measurement in between valuations is cost or historic value, in which case, when you've spent what you've spent. The other is to say revaluation things. And I think that probably there is a judgment that here between you have built an entirely new hospital and you have done a minor bit of capital addition to an asset. One end of those valuing that asset and having a new starting number is clearly massively overkill to a relatively small amount of spend, versus an entirely new asset where are you starting from the right value is different. I think that's a difficulty there.
Thank you. That's really helpful. And another question, moving us on to business cases. I think you referred to it in the capital programs. Can you please provide some more detail as to what exactly are the challenges around early stage business cases, case costs, demolition costs, and vesting certificates? Is that something that?
Yeah. I mean, I might characterize that challenge as they're not capitalizable. So an early stage, you can only capitalize when you have reached the stage required in IAS 16 to capitalize costs, which is having demonstrated the technical, economic, amongst other things, the technical and economic feasibility of a project you're proceeding with and something you're committed to. if you're at the stage, for example, where you are examining 5 or 6 different options of what you're going to proceed with, you have not got an identified asset that you are proceeding with, developing and to capitalize costs into. If you're at the point that you have, there has been a decision by the organization to proceed with a specific project, and at that point you are starting to incur costs on design of that specific project, and you are committed to proceed with it, then you've got something to capitalize on. If it is uncertain whether you are proceeding, you probably haven't met the IS16 test for it. So that's a difficulty, because often there may be some funding that has been provided for it which states that it is to be treated as capital funding, but the items are not meeting the test to be capitalized. Demolition costs, so there may be some slight differences in interpretation of this between firms, but our view would be 16 is pretty clear that unless you have bought an asset with the intention of demolishing it, so you buy a rundown building to knock it down and build something new, then demolishing that was part of the plan for building the asset, and you bought just the cost of this rundown building is part of the cost of building your new asset. In that case, you capitalize. If you've had a building you've been operating for 20 years and you're knocking it down and replacing it with something new, it is hard to see under the standard how those demolition costs are capitalizable. And vesting certificates. So vesting certificates partly more as a value for money thing, but can be about asset recognition as well. There have been organizations who have used vesting certificates to recognize, or appear to have done so, to recognize capital spend earlier than they would otherwise have done so, and to be making and for a vesting certificate to be legally valid, you have to have made payment earlier than you would otherwise have done. So you are paying cash that you didn't need to do in order to assert that you have title to an asset that is not on your site, not usable, etc., where you could have not paid for that, and whether that actually represents good financial management, and whether that is consistent with the principles of managing public money about not making prepayments or payments in advance of need, is an issue that we and other firms have challenged at a number of cases, and in a number of cases whether whatever you've got a vesting certificate is on meets the sort of control criteria in international financial reporting standards to recognise an asset. And there have been some significant items where firms have had the view the answer is no.
That's really helpful. Thank you. I was going to ask you, actually, when you talked about it being the full year of reporting for the public sector for TCFD, you referred to it being not an audited disclosure, but something that you have to kind of read and look at. Can you tell us a little bit more about the distinction between the kind of not audited, but it feels like it's been audited kind of thing, and other areas that are like that in terms of the annual report?
So the financial statements themselves are subject to audit, and certain specific disclosures in the front half are also subject to audit. Although in a couple of cases, often just very small numbers, and so may not test something if there's been a K item, redundancy payment, something may not actually touch it. Everything else in the annual, the starting point in auditing standards is everything else in the annual report is called other information. And the auditor's responsibility for other information is to read it for consistency with what is in the audited financial statements. And if they identify material inconsistencies, there are then things that one would do that ultimately would end with qualification if it's not corrected. The TCFD disclosures are inconsistent with the financial statements or things that you are aware of from your audit. Things that sort of cross over with risks, things we'll look at from our VFM work, annual governance statement we specifically sort of look at separately amongst this, but it's the same thing of, is it consistent with what we understand, and is the whole thing fair, balanced and understandable from what we know? That's what we're thinking about. So if there's a pound number, so in the front half, remuneration report is audited. your disclosures about financial performance are not audited figures, but most of them are numbers that come directly from the financial statements. So, if your number in the front and the back were different numbers, we would say obviously that's a problem. But if there's something that an example often was about, if people are including sort of pound numbers that go with energy costs or something, that's not a number that must come from the ledger somewhere, but it isn't an audited disclosure, and it's not necessarily a number that's exactly in the back. So it's a sort of, is this consistent with what we're expecting as you read through it, but not necessarily ticking it back. And you've got to make a judgment of which numbers would we expect to have seen, and perhaps checking something through. Different auditors will make different judgments depending on and for different annual reports, depending on what's being said and how obviously it is a number that ties back or not. But the sub is you're reading it for consistency.
That's really helpful. Thank you. And I'm going to flip us quickly back to capital. What is your view on whether you can ever capitalise feasibility costs, for example, when the project does go ahead?
So IS 16 would say you can't go backwards. So at the time you incur a cost, it is either capitalisable or an expense. And when things change later, you can't go backwards and change it to being capitalised. There's a reasonable amount of grey around these things, but that would be the starting point.
Well, thank you. Last one from me. Something that we've been talking about at the Governance and Audit Committee at HFMA for a while now is the new Economic Crime and Corporate Transparency Act. Are there any implications for the year end from that? And if there are, can you tell us a bit more about the audit view of those?
This is the failure to prevent fraud.
Yes.
Yes. Yes, I hadn't touched on this. This does feel like this is a concern. We should be concerned for organisations versus for auditors. So the setup of local counter fraud, NHS processes, well, there's a lot of structure is about protecting the NHS organisation from being defrauded by the outside or by staff internally, but it's protecting the organisation. The failure to prevent fraud offence is about whether the organisation has taken advantage of somewhere else. And so things like if there is information in a grant claim, if there is something wrong about tax filings, if there are things where achievement or where getting an extra pot of funding based on achievement of particular financial outturn or against emergency room performance or something like that. If these things where there is something you are reporting out to the outside world has financial benefit and outturn to you, and something were wrong with that, that would be potentially falling within the failure to prevent fraud offence. And so things that the auditor has considered as fraud risks around estimates and judgments, if there are points being raised about inadequate control there or risk incentives there, that is the bit that is tying up to, do you have appropriate arrangements in the context of the failure to prevent fraud offence?
Thank you. Thanks so much, Ben. Can we squeak in a very quick answer on can payment on accounts be capitalised?
Yeah, so probably it depends what you mean by payments on account, but probably the answer there, Nali, is no. So if what you've done is you've made, the question is, have you received a capital asset or work being done on the capital asset? If you've paid someone in advance of their work, a supplier in advance of the work being done, that's a prepayment rather than a capital item.
Lovely, thank you.
Thank you to Ben and Lisa for that session. The HFMA has produced a series of resources to support those involved in the planning and delivery of the 2025-26 annual report and accounts. We'll link it in the show notes. That's it for this week's episode of HFMA Talk. Thanks for listening. Don't forget to subscribe so you never miss an episode. And if you enjoyed the show, we'd love for you to leave a 5-star rating on your favourite podcast platform. See you next time.